It was many years ago that I attended a conference in which Robert Reich, Secretary of Labor under President Bill Clinton, related an anecdote in which he made a prediction regarding some facet of the economy, which it turned out was dead on. As Secretary Reich told the story, journalists and economists the world over sought him out attempting to determine the analytics behind his wisdom. With a wry smile, Secretary Reich noted to this audience that he had, in fact, been making that same prediction for years, and this time it just happened to be correct. The point of his story was that no one can predict the future. This includes an inability to determine the direction of the market, the cause for any particular change, when those changes will occur, or the extent of the change itself. A review of the available commentary will always find prognosticators and, like playing the lottery, a small number will be winners. The difficulty comes when that person is held up as a foreteller of the future. Hello, and welcome to another edition of Caratel's News and Notes. My name is Barry Katz. I am president of Caratel, and I need to admit that my crystal ball is about as cloudy as anybody else's. Neither I nor anyone else can predict the future with any degree of accuracy. Like any roller coaster, you need to be taken to the top before the ride you paid for and expect really begins. For the U.S. equity market, that rise has been going on for over 10 years, until the fourth quarter of 2018. For the year as a whole, 2018 was a tough year across all sectors of the market. To give you some perspective, take a look at this chart. It was only U.S. bonds which managed to eke out a positive return, all of 1 basis point. Cash was the actual headliner with a positive 1.8% return. But taking an even closer look, while the first 3 quarters of the year were wonderful, it was the horrible fourth quarter that dragged everything down. This chart illustrates 2018 as a whole, the first 3 quarters and the fourth quarter alone. As we talk about diversification, note how the fixed income components of the market performed in opposition to the equity components. Delving further into 2018's performance, a historical look across 8 major asset classes shows that how unusual 2018 was, in that no major asset classes had a return above 2%, the first time that's happened since 1972. And it wasn't just in the US. If you look around the globe, of the 72 global markets, 90% were in territory for the year. But let's put 2018 into proper perspective. Part of the price we pay to be in risk assets like equities is that on occasion, we're going to have a negative year. What you see here are the calendar year returns of the S&P 500 going back to 1979. You see that about every 8 or 9 years we have a negative year. So, a negative year after many positives is not entirely unexpected. Further, if you look at the orange line, you see the average return over this time period, but there was actually not a single year that generated that return. Rather, every year actually performed either better or worse than the average return. That's called volatility. It's only by staying invested throughout the whole period that you can reach that average return. But that was looking at calendar years. Diving even further, if you look into each of these years, you can see volatility in each calendar year. 2017 was actually the odd duck in that every month produced a positive return, and the intra-year drop was less than 5%. That's only happened once before, in 1995. 2017 lulled us into a false sense of security. So with all of this, we are the ones who have to deal with the emotions wrought by this market. Emotions tell us that we have to do something, but what? The problem is that we don't know when to exit and when to enter the market. For example, if we go back to the end of the tech crash of 2002 and invested $10,000 to the end of 2018, you can see where we'd be. What you can see is that if you stayed invested and didn't react to emotions and try and move in and out of the market, you would have done better than if you missed months sitting on the sidelines. But let's say that you didn't watch this video and you let your emotions lead you out of the market. The next decision is, well, when do you get back in? Here's a chart illustrating someone who gets out of the market after the 45% loss, and then waited until the market had recovered to the previous point as a sign to get back into the market, versus someone who just rode out the storm. What you see is that you've lost out on almost half the gain of having just stayed investing over the 2-year period illustrated. It's not uncommon after a period of volatility to hear a number of investors say that they're going to wait for the market to settle down. Think about the fact that after volatility, markets tend to actually settle up versus settling down. To illustrate, look at the subsequent returns after quarters with losses of 15%. You see the potential for settling up after market turmoil. So, we need to acknowledge that the use of equities in portfolios for enhanced return is necessary. We also know that we need to hold those equities for a while, even though we'll likely be taken for a wild ride on occasion. This is where diversification comes into play. This chart illustrates the interplay between stocks and bonds. By diversifying between asset classes and, for Caratel's clients, various strategies within those asset classes, we work to smooth out the ride. Diversification not only helps limit the fall, but also works to shorten the recovery time. Now, I could go on for quite some time, but I feel like I've already overstayed my welcome. It was Prime Minister Benjamin Disraeli who is generally credited with stating there are three kinds of lies: lies, damn lies, and statistics. It is possible to find performance and market timing examples to refute the illustrations I've included in the video. There is not enough time in this video newsletter to highlight the economic fundamentals of the US and the world. We can certainly do so in a future video if you like. But since no one really knows for certain, we can only base our actions on what has worked over the long term in the past. We know diversification works, market timing doesn't. Over the long term, equity markets rise, bonds are the insurance policy of the investing world. I hope that you found this video somewhat interesting and informative. Your feedback is most welcome and appreciated. It really is the only way I can improve these videos. Until next time, thanks for watching.